Hi, I'm Sharon Winsmith, a tax attorney, active investor, and your go-to resource for proven investment and tax planning strategies. In this video, I'm going to talk to you about why I never invest in real estate through REITs and what I think are better approaches for real estate investing. As smart, savvy investors, we know that we need to allocate a portion of our portfolio to real estate investments. So the context of this video is that we're going to talk about what are the best approaches to investing in real estate. I want to be clear from the start that anything I say in this video is intended to be my own personal opinion based on my own experience with managing my real estate investments and with working with other people to assist them in tax and investment type planning around their investments. I am not intending this to be investment advice. And as always, with everything, you need to do your own research and make your own decisions about what are the best investments that you should make. So let's start with just remembering what is a REIT. So for those who don't know, REIT stands for Real Estate Investment Trust. A REIT is really a special, type of tax entity. It is a company that is going to invest in real estate or real estate type financing deals, but it is really just a very large company in most cases. And the term REIT is a special type of tax classification for that entity. In order to be a REIT, you're required to satisfy a lot of different qualifications and requirements every year. It actually gets quite complicated. I personally, when I used to do consulting, advised a number of the largest REITs out there, on a lot of these tax implications. And I've worked with REITs as an advisor for a number of years in the past. So I really understand how these work, but I don't think it's important that you know all the ins and outs of the requirements as an investor. What I do think is important is that you understand that a REIT is really just a company that invests in real estate, and it does so in a way that it is going to not have to pay a corporate level tax. So to qualify, the whole point of qualifying as a REIT is that you can avoid that entity level tax that most large companies that are, C corporations have to pay. So if you invest in shares of stock in a public company like Coca-Cola, for example, that is a corporation, and Coca-Cola has to pay corporate tax on their profits. Then distributions to you, the shareholders, are also taxable. So there's two layers of tax. But with a REIT, if you qualify as a REIT and get to maintain your REIT status, you're going to get pass-through tax treatment, which means that there's only one layer of tax, and that is to you, the shareholder of the REIT. So that's a benefit of the structure and the way it's set up. I said I wasn't going to go through all the, tax requirements because I don't think they're important to you as an investor. What I do think is important is that you understand that they are required to distribute 90% of their income to shareholders. So, with real estate investing, you typically do get current cash flow. That's kind of the whole point of real estate investing, is that you get cash flow from the deal. It's a good cash flowing, type of asset to own, but REITs are required to actually distribute out 90% of their income to shareholders. I will explain to you why I actually think that's a negative to REITs later on in this video. Typically, anyone can invest with no minimum, so you don't typically need, a minimum amount of money to invest in a REIT. What I'm talking about here are publicly traded REITs, so I'm not talking about private REITs. That is a separate thing, and I think a completely different issue. I'm talking about REITs that are very large. They're publicly traded. You can go out, with no minimums usually, and just buy shares. The same way you would buy shares of stock in a company like Coca-Cola, you can go out and buy shares of stock in a REIT. So, what I'm talking about in this video are just publicly traded REITs, and I'm going to compare those to other forms of real estate investing. So again, I've been very clear. I don't like REITs. That's my personal opinion. I will never, ever, ever invest or own a REIT or shares in a REIT. I think they're probably the worst way you could invest in real estate. What do I think are better approaches? So if you're an accredited investor, I think, in my personal opinion, the only way I invest in real estate right now is through private real estate funds and syndications. I've talked a lot about investing in real estate privately through real estate funds. If you're not, if you haven't seen those other videos, check those out. You've got to understand that once you reach that accredited investor, status, you're going to be open to this world of alternative investments. And a lot of those include real estate funds and syndications. I'm going to refer to real estate funds and use that interchangeably with syndications, but they are different. But I'm just going to use, real estate funds for purposes of this video. I am not talking about mutual funds that invest in real estate. We do not like mutual funds. You absolutely never want to invest in mutual funds. It's my personal opinion. If you don't understand how bad mutual funds are, please, check out my videos on that. Check out anything on the web on that. I think that's pretty well known that you do not ever want to invest in mutual funds. There are always better ways to invest in whatever you're trying to invest in. I'm talking about private investment funds that pull together money from investors and go out and buy real estate properties and usually manage those properties. If you're not an accredited investor yet, you're probably asking yourself, I can't go out and invest in good quality, real estate funds. There may be real estate funds open to you, but, that's not to say that you should necessarily invest in those. I think the best, real estate quality sponsors in the space are going to limit their investments to accredited investors only. So if you're not yet an accredited investor, you can go out and buy properties directly. You do not need a ton of money to do that. I know a lot of people who do that. I know a lot of people who have built, good savings and good net worth by, owning properties and going out and buying them directly. I've done this in the past. I don't do it now. I personally, it's my own personal opinion, would much rather focus on my businesses than investing in real estate. I just didn't like it. I wasn't really my thing. And I found that I could get much better returns by just doing it passively and investing with real estate funds and syndication. So that's my preferred approach. Anyone who's able to do that, certainly, if you're talking about REIT versus private funds, I can't imagine, if you really know what you're doing, that you would still invest in REITs once you understand the world of, investing in private real estate funds and syndication. So the rest of this video, I'm going to really focus on contrasting REITs as opposed to real estate funds and investing that way. If you're not an accredited investor, you can do it directly yourself. You don't have to go through a fund. You can go out and start buying properties that can be as small as you want, and you can just keep rolling those up into bigger properties in the future. So I'm going to do REITs as opposed to real estate funds, but the real estate funds, anything I say about that is going to pretty much apply to you, if you want to start managing portfolio properties yourself. I want to start with the tax issues with REITs. So there's both tax and non-tax reasons that I don't like investing in REITs, but I think that one thing that's important to understand is that investing in real estate is really mostly about the tax benefits that you get. This is why real estate is the best investment you can make from a tax standpoint. It's largely because of the fact that you get current cash flow from your investment. So you're kicking off current cash flow from the rental income, and you usually show an overall tax loss on your tax return because of very large depreciation deductions. So you're getting positive cash flow, but you're not paying tax on that income, at least not currently. So that is the biggest reason why real estate is such a great investment from a tax standpoint. So to start with, I mentioned that depreciation deductions are probably the biggest reason why you show a net loss from a tax standpoint on your tax return, and depreciation deductions are usually lower with REITs. So as I mentioned at the start, I have advised some of the largest REITs on the tax side. I've also worked with investment funds in real estate of all different sizes, so I really understand how this works on the tax side of things. And depreciation deductions are almost always going to be lower with REITs, at least in my experience. There is a number of reasons for that. It is largely, due to the fact that REITs own all types of different properties. Their portfolios are huge. They, you as the investor aren't going to have any clue what you're investing in, and they aren't usually able to take advantage of as many good tax planning strategies as someone who's investing through something smaller like a real estate fund, or certainly if you're, owning properties directly. What's important to note about the tax stuff before I dive into this in more detail is that nobody really lays this out, I think, in a very accurate way, or at least a way that really matters. They talk a lot about the fact that if you look up disadvantages to REITs, they're going to tell you that it's because REITs kick off ordinary dividends, and that's taxed at the highest rate. Well, that's true, but here we're comparing REITs to private investment funds, and net rental income from an investment fund, or if you own properties directly, that's also taxed at the highest rate. So net, at the end of the day, you're going to be the same usually, whether it's a REIT or some other way of investing like through a fund or directly, except for in these cases that I'm going to talk about here on the tax side of things. So as I mentioned, depreciation deductions are usually lower. This is because you're investing at all different stages of the property's life cycle with, that's owned by the REIT. What happens with REITs is, they give you're going to do an average depreciation rate across all of their properties. And that's the rate that's going to apply to your ownership as a shareholder in that company. So it doesn't have to do with when you bought in, when those properties were acquired by the REIT relative to the time period that you held, your shares. So you're just coming in all different stages of depreciation cycles. A lot of cases you're going to be coming in when there's older properties owned by the REITs that have a much smaller depreciable basis. Lots of cases, times depreciation gets much lower towards the end of the property's life. Yes, the REIT's going to be acquiring more properties in the future, so that may offset. But in a lot of cases, it doesn't. So you don't really, necessarily get your accurate reflection of what should be your depreciation allocation as a shareholder. Also, depreciation recapture happens when, the REIT or anyone, sells real estate. So you're going to pay, yes, you got to take depreciation while you own the properties, but when you sell those properties, you've got to recapture and pay recapture tax on that. That recapture tax rate is usually lower than what you would have paid over otherwise. But with REITs, and a lot of times you may be paying depreciation recapture that is more than the benefit you received. So if they sell a property that, you only really technically own for a year or two, but that the REIT owned for 10 years, you're going to be paying a large depreciation recapture tax on that, even though you only got the benefit of depreciation for a year or two. So it doesn't really line up with your investment. It can be phantom income in a lot of cases, similar to an issue with mutual funds, where you're just investing in something where it's just so much crap. There's frequent turnover, you're paying tax on it, and it doesn't necessarily tie, or never is going to tie, to your ownership. So also, another thing is that REITs rarely use bonus depreciation. I'm talking about very large public REITs here. They just don't, for a number of operational reasons, usually don't take advantage of bonus depreciation. I think bonus depreciation is one of the best things, available under the tax code. This came under the Trump tax law changes a few years ago, and it's a way that you can accelerate your losses with real estate investments for the next few years. In 2023, you got 80% of bonus depreciation, and that goes down 20% every year. But right now, it's a great tool to accelerate and increase your losses earlier in your investment horizon. So, the fact that REITs don't take advantage of that, but I've never invested in a fund that didn't. If bonus depreciation was available, I probably wouldn't invest in that fund if they weren't taking advantage of that. So that's pretty standard procedure with most real estate investment funds. And certainly if you're owning properties yourself, you should absolutely be doing cost seg studies and taking advantage of bonus depreciation as much as possible. With REITs, I've kind of alluded to this before when I was talking about depreciation, but you just don't have predictability around the tax outcome. So, I have absolutely no clue what to expect from the REIT. There's so much turnover. You don't know what you own. You don't know what they're going to sell, what they're going to buy, when, what your depreciation is going to be, your allocation, if you're going to have net, positive income that you've got to report. So you can't predict your taxes. You can't use tax strategies where we try to take losses from real estate investments and offset that against other passive income. We use that strategy a lot, by converting income into passive income that is able to offset. We can't use all passive types of income. So you can't take like dividends and interest, for example, and offset that with real estate losses, when you're a passive investor. But we have tons of tax planning strategies where we use other income to offset the real estate losses. You're not getting bonus depreciation, so you're not getting really large losses from, newer investments to offset maybe net positive rental income from other, older investments where you're later in the stage of depreciation cycles. So you just can't predict. You have no clue what to expect, so you're not able to do any planning around that. And I think that's a big, big problem. Also, REITs, you're never going to get the ability to 1031 planning. 1031 like-kind exchange planning is a great benefit to real estate investing. So you can basically defer capital gains tax forever if you keep using this strategy. And you are basically, I'm not going to dive into what it is, but in detail, but 1031 like-kind exchanges are where, you sell property A, and instead of paying the capital gains tax on property A, you roll those gains proceeds into property B. So you basically use property B as a replacement property A, and you can defer paying any gain, capital gains tax on the gain from your sale of property A. So it's a great strategy to defer taxes on real estate investments. It's very powerful, and you can and should use the strategy if you're owning properties directly. You cannot use 1031 planning in most cases with investment funds. They just don't, have the ability to do that. But there are some smaller ones that do provide 1031 planning that are great. And, you do have the potential to find funds that will do 1031 planning. You can certainly do it if you're owning properties yourself, but you're never going to be able to do that with a REIT. So that's another reason why the tax benefits are lost commonly, when you're investing through REITs. So let's just talk a little bit about the other issues that are not tax related that I have with REITs. So this is really a comprehensive list of why I don't like REITs. I started with the tax benefits. They're almost always better with private funds and direct ownership, certainly. So, that to me, when the biggest benefit of investing in real estate is really the tax benefits and strategies I can use with it. If those come off the table, a lot of those come off the table with REITs and there's less predictability, then I like funds much better to that, and certainly direct ownership. Also, REITs typically have lower returns. This has been my experience. REITs, in my experience, typically average about 8 to 12% returns on average every year. That's an okay return. I'm happy with 10, 11, 12%. I'm not happy with 8 or 9%, but that's a decent return. But a good quality fund should well exceed that. I'm not, if I were looking at, real estate fund or deal to invest in, If the minimum projected, estimates for that for average returns was not at least 12% at the minimum, then I wouldn't even look at it. So in my experience, good quality funds and good quality sponsors should be getting returns exceeding 8 to 12% a year. But what's critical here is that you make sure you invest with good quality sponsors. I have a course that I dedicate solely to finding good quality sponsors, my process for how I find good sponsors to work with, invest with, and good deals. Don't go out there, invest through something like Fundrise, or don't invest through, influencers like Grant Cardone or Ken McElroy. You've got to find good quality sponsors who are really well respected in the space and have been, have a great track record and been doing this for a long time. If you do, you will find that the returns are far higher with something like a private fund as opposed to a REIT. I've mentioned before, I don't like the 90% distribution requirement for REITs. I think it creates operational inefficiencies. They're not able to, maintain, I think, adequate reserves to prepare for unexpected expenses in a lot of cases, or to take advantage of really good acquisition opportunities in the future. So I really don't like that 90%, distribution requirement. I also think it can limit their ability to reinvest proceeds and money in a way that you can have real growth. So I think the 90% distribution requirement, that, if they don't meet that, they have to meet that, right? Like, that would be very bad if the REIT didn't meet that, because that would mean they weren't going to qualify as a REIT. And then there's 2 layers of tax, which any shareholder of a REIT is going to be really upset about that. So I don't like it. I think it, creates a lot of inefficiencies in how the fund or the company operates. I think REITs are just too large. We're talking about publicly traded REITs here. I think they're massive. You don't have any clue what you own, where those properties are located and that type of thing. But I think they're very inefficiently managed. So REITs, unlike funds, outsource, most of the real estate services. So that means the company has no control over timing, over budgets, and costs and that type of thing. Whereas a real estate fund, they're going to be very much involved. In some cases, they may be doing a lot of the real estate services themselves in a separate company, but they're certainly very involved in the day-to-day operations. They're not going to outsource that in most cases, at least not funds that I would ever invest with. So I think you lose a lot of control, and I think you lose a lot of efficiencies when you do that. Also, REITs, when they have cash and, if it's there, they've got to invest it. They've got to make acquisitions. They can't just sit here and hold on to cash for too long and have a bunch of cash drag. So whereas with the fund, they make capital calls and they can spread those out. And so they don't have to just make acquisitions because they've got money. They're not going to call your money from investors or all your money until they've got that acquisition picked out. So they're not going to just make investments because they have to and because they don't want cash drag. They're going to be able to plan for that. Whereas with the REIT, if it's there, they've got to make those acquisitions. They don't have as much flexibility over control over that. You as the investor have limited control. So as I've said this a number of times, you don't know what they own. They own a bunch of stuff you don't really know. They are required to make disclosures and stuff like that. But you as a shareholder of a REIT, you're not going to have any clue exactly what properties you own, where they are. I like to be in control. So when I'm investing through a fund, I know, I've got Fund A owns, multifamily properties in Georgia, whereas Fund B owns industrial properties in Texas. I can make sure I'm diversified geographically. I can make sure I'm diversified with the types of properties I'm invested in, and I have control. I understand exactly what I'm doing, what the strategies are. With the REIT, you're not going to really understand the underlying strategies the managers have, if they really even have a good strategy. So I don't like the lack of control when you're investing through something so big like a REIT, as opposed to an investment fund, or even better, doing it yourself. People talk a lot about liquidity that REITs provide. Yes, they provide liquidity. If you buy a share of a REIT, you can sell it tomorrow. So it is very liquid. A private fund, or, owning properties directly yourself, that is not liquid. I'll be very transparent about it. It's not. But why should that matter, right? We're good long-term investors. We've decided this real estate investment makes sense, or these real estate investments through a fund makes sense. I buy into the strategy, which is holding the properties usually 5 to 10 years. I'm happy to invest for the long term. So why do I care about liquidity? Yeah, you don't want 100% of your money tied up in investments that aren't liquid. You need to have some liquidity, right? I understand there's always unexpected costs or things that could happen. So I would never have 100% of my investments in illiquid assets. But real estate is just a small portion of your portfolio. And no, it's not going to be liquid, but I don't care about liquidity. I'm a long-term investor. I'm not going to be selling shares of my investment fund. I can't. And I certainly, wouldn't want to sell shares of a REIT. Let's say I did invest in REITs for some reason. I'm not going to be selling those, right? Like I want to buy, borrow, die. I want to hold for the long term, whatever it is, I want to hold those shares for a long period of time. So I don't really care about liquidity. I think you should have other investments that provide liquidity, not real estate. REITs have less focus on long-term investing. This goes back to what I was just saying about liquidity point. They're not buying properties and, coming up with these strategies with respect to each property. They're just too large. They're not thinking about, I'm going to hold these properties for 10 years. We're going to do renovations and, do cash out refis and improvements and bring rents up to market prices. Like they're just not doing that. They're not really focused on long-term investing, whereas funds definitely are. Some funds have indefinite lives, but most funds, you're buying large properties, even, through the fund, but they're long-term strategies and long holding periods. So, I'm a long-term investor and I certainly want the fund or manager, whoever's managing my money, whether it's the REIT manager or a fund manager, to be having that same long-term investment thoughts and thinking, long-term strategies. Also, these last two kind of go hand in hand, but this is probably, if once you get through the tax benefits, not being as great with REITs, I absolutely hate the facts that REITs are correlated to the stock market. So the whole point of investing, or one of the whole point of doing asset allocation, allocating your investments across different assets, a large portion of that is diversification. If you're investing in real estate through a REIT, through something that's 100%, almost 100% correlated to the stock market, then you're not diversifying, right? As the stock market goes up, REITs are going to go up. As the stock market goes down, your REIT share price is going to go down. So you don't want to be correlated to the stock market by investing through a company that just happens to be focused on the sector of, real estate. It just doesn't make sense, right? You want to diversify, where when you're investing in real estate through something like a private fund or buying properties yourself, that is typically not correlated to the stock market. So that provides some diversification. And I don't want to, invest in something that's just going to go up when the stock market goes up and go down when the stock market goes down. That just doesn't make sense at that point. And lastly, this is basically kind of the same type of concept, is that with a REIT, you're buying shares of stock in a publicly traded company. So that pricing is speculative. REITs are subject to those same market dynamics that any publicly traded stock is. So we know that, public stocks can be influenced by a lot of factors. And in a lot of cases, those factors don't make sense, right? And in a ton of cases, they're not really tied to the performance of the company itself. It can be tied to all kinds of crazy things. It's very speculative in nature. It's supply equals demand, with the stock market, as with everything, but that can change. It's extremely volatile. So I don't like how REITs are basically shares of stock in a company that just happens to be in the real estate industry. I think it's basically stock market investing. I think it goes back to the same thing. Then you get back into this stock picking concept. Which REIT should I invest in? And then you're just doing stock picking, right? Because the shares of a REIT are just stocks at the end of the day. And I hate that. I think, speculative pricing and volatility and, all the things that you could say are negatives to the stock market, they're going to be there with a REIT, right? And you're also kind of lacking that diversification that you want by allocating to different asset classes, which are real estate investments. So I know this was a long video, but I really think it's important to understand why I think REITs are not the best way to invest in real estate. Unfortunately, I do a lot of videos on how great real estate investing is from a tax standpoint, all the benefits, how you can get a tons of benefits, both tax and non-tax, from real estate investing. And then I get a lot of comments about, okay, which REITs would you buy? The answer is none. I would absolutely never invest in a REIT. I hope you understand why after this video. I think there are much better approaches to real estate investing. If you're interested in the world of private investment funds, real estate funds, and even other types of funds beyond just real estate, I'll link below to my course on that. It's probably one of my most popular courses, if not the most popular, which shares my process for finding good quality sponsors and deals to invest in, because that's critical to this. You don't ever want to invest with someone who is not good quality or not going to do a good job, because that makes any investment a bad investment, right? So hopefully you found this video helpful. You have a good comprehensive understanding of why I absolutely hate REITs. If you found this helpful, please like the video and subscribe to the channel.